What if I told you that your obsession with perfect entries is killing your performance? That your need to chase trades because the price is moving, because a candle looks strong, because you feel you're missing out, is the very behavior that's separating you from consistency. Every time you hit buy because it feels right, you're not trading the market, you're reacting to it. Dalton says the first job of a trader isn't to trade, it's to observe the auction. Before you act, you must understand the context in which the market is moving, not the pattern, not the news headline, the context. What's driving this movement? Is this continuation or excess, acceptance or rejection? These questions define your edge, and they begin by separating emotion from information. When you open your trading terminal, your eyes are instantly pulled to price. The temptation is to judge each move in isolation. But price by itself is meaningless. It's just a number until you frame it in the broader auction process, an unfolding balance of buyers and sellers. This is why most traders lose. They focus on the last tick, not the underlying narrative. You need to reverse that. To read context, you must first stop being surprised. And the only way to stop being surprised is to expect two-sided activity. That's what markets do. They auction. They move to test higher and lower. When you chase one side without understanding the balance that preceded it, you're just another participant caught in the emotion of the moment. The market's not punishing you. It's just doing what it always does, and you weren't ready for it. Let's be honest. You've felt it. The market rallies and you chase. Then it pulls back violently and you panic. But what if you knew that rally was actually a test of an unfair high? What if you understood it wasn't supported by volume or that value hadn't moved? You wouldn't chase. You'd wait. You'd watch. And you'd be right to do so. Context begins with asking, where are we in the auction? Are we in balance or out of balance? Are we accepting a new area of value or rejecting an old one? Dalton emphasizes that you don't need to know where the market is going. You need to know what phase it's in. That one distinction can change your entire approach. It transforms your role from gambler to observer, from guesser to strategist. Let's go deeper. Think about a day that starts with an open within the previous day's value area. What does that typically imply? Lack of conviction, potential chop, a day for rotation trades and fading the extremes. But what if the market opens with a gap above the previous day's high and starts building value higher? That's not noise. That's potential change. You can't trade those two scenarios the same. But most traders do. Why? Because they're not seeing context. They're only seeing price. This is the power of understanding the auction. When you build context, you stop reacting. You stop guessing. You start anticipating. You start asking, what behavior would confirm continuation? Instead of, how can I catch the move? The former is process-based. The latter is emotional. Context gives you the confidence to act with purpose, or the wisdom to stay out when there's no edge. Dalton reminds us that markets constantly seek balance. Every move is either creating a new balance or extending an old one. You're not in the prediction business. You're in the observation business. Your edge isn't your setup. It's your ability to read what the market is trying to do and whether it's succeeding or failing. This is why setups fail for traders who don't understand context. They don't know when a setup has context on its side and when it doesn't. So the next time you find yourself reaching for the buy button because it looks strong, stop. Zoom out. Ask yourself, where is value? Are we moving away from it or returning to it? Are we breaking balance or returning to it? Only then do you earn the right to act. Don't skip this step. Don't think you can afford to just take a quick trade. That's the old you. And the old you keeps losing. This is your wake-up call. Chasing is the language of fear. Context is the language of professionals. You must choose your language. You've been told to treat indicators like tools. Plug and play, signal and trade. But what if I told you that market profile isn't a tool at all? It's a lens. A way of seeing the market not as isolated bars, but as evolving relationships between time, price, and volume. When you stop treating market profile as another signal generator and start using it to perceive context, you step into an entirely different world of trading. James Dalton didn't write Mind Over Markets to give you a gimmick. He wrote it to give you perspective. The kind of perspective that transforms confusion into clarity, chaos into structure. Market profile isn't there to tell you what to do. It's there to show you what's happening, so you can decide how to respond with intention, not impulse. Think of it this way. Most traders look at price charts like a flat surface. A candle closes higher, and they think buyers are in control. A red bar appears, and they scream, reversal. But none of that matters if you don't know where value is developing. None of it means anything without understanding where the market has accepted price. That's where market profile shines. It doesn't show you where price has been. It shows you where price has mattered. The profile organizes price by time and volume. Every letter or block you see isn't just a shape. It's a record of where business was done, where buyers and sellers agreed, and where they rejected price. This tells you far more than a moving average ever could. It shows you the market's actual process, its heartbeat, its logic, and its dynamic. Every new tick is either building value or attempting to escape it. Here's the hard truth. If you use market profile like a mechanical tool, you'll fail. It's not meant to generate buy and sell signals. It's meant to teach you to think like a trader, like an auctioneer. It trains your eyes to see balance, imbalance, and transition. And that shift is what separates amateur from professional. Dalton teaches that the profile allows you to visualize the auction process, to see not just where price is, but what it's doing. Are we in balance, chopping between unfair high and low? Are we trending, discovering a new area of value? Is the market accepting new territory or rejecting it? This is not data you can pull from an RSI. This is structure. This is insight. And let's be clear, structure wins over emotion. Every time. With market profile, you begin to think in terms of development. You stop saying the market's going up. You start saying the market is building value higher, or we're rejecting the prior day's value. That's not just semantics. That's a fundamental change in how you process information. You become less reactive. You trade with patience. You become a student of context. Let's take an example. Say the market opens with a gap higher and immediately begins to auction sideways. The average trader sees indecision. You see value building. Then the market breaks higher again. Was that predictable? Not from a candle pattern, but from market profile. You saw early value formation, low volume rejection below, and the potential for initiative buyers to step in. That's not hindsight. That's vision. And it's not about knowing what will happen next. It's about knowing what is happening now and adapting. Market profile helps you make sense of the moment, and that sense gives you confidence. The confidence to hold a winning trade. The confidence to step aside when structure isn't clear. That's what the best traders have. Not a crystal ball, but a process of perception. This lens doesn't replace your experience. It amplifies it. If you're trading momentum, market profile helps you gauge whether that momentum is contextual or random. If you're mean reverting, profile tells you where balance exists and where the extremes are ripe for fades. It doesn't limit you. It empowers you. So throw away the idea that market profile is just a graphic. It's not something you glance at after a trade. It's how you see the market before, during, and after execution. It's how you ask the right questions. Where is value forming? Are we in acceptance or rejection? Is today confirming or challenging yesterday's structure? These questions reframe everything. Dalton said, the market isn't trying to make you money. It's trying to facilitate trade. When you adopt the market profile lens, you finally see the auction for what it is, not a machine to beat, but a conversation to understand. Stop using tools. Start using insight. See the market as it is, not how you wish it to be. You're not here to predict the market. That's the myth you've been sold. The myth that tells you there's a perfect strategy, a magic indicator, a secret signal that will forecast the next big move. But prediction is a trap. It feeds your ego and destroys your account. What you need instead is structure. A process grounded in the reality of the auction, not the fantasy of your forecast. Dalton is crystal clear about this. The market doesn't reward opinions. It rewards adaptability. You're not paid for being right. You're paid for executing with consistency within the framework of the auction. That means understanding how value is evolving, how balance is forming or breaking, and how your trade fits within that structure. When you trade without that awareness, you're not executing a plan. You're gambling with your gut. Structure is about framing each session, each move, in terms of auction behavior. Are we in balance or out of balance? Are we developing value higher or lower? Are we trending or reverting? This mindset lets you detach from the need to be right. You stop predicting the outcome, and you start responding to what the market is telling you. That's how professionals think. That's how you build a sustainable edge. Let's take a closer look. Suppose the market opens within the prior day's value area. That structure suggests balance, likely two-sided trade, fading extremes, limited directional conviction. But if the market opens outside the prior range and begins to build value beyond it, the structure has changed. Now we're dealing with initiative behavior, potential trend development, directional conviction. Same chart, same tools, entirely different mindset. Without structure, you're chasing price. With structure, you're trading narrative. Structure gives you a reason to wait, a reason to pass, a reason to strike. It keeps your decisions grounded in the behavior of the market, not your emotions. Dalton explains that structure is derived from three core elements: time, price, and volume. These are the pillars of market profile. Time reveals where price is accepted. Volume confirms or challenges that acceptance. And price? Price is just the surface. It's the final output of the auction, but without context, it means nothing. You must learn to view each market session as a story. Structure is what ties that story together. Early balance leads to late imbalance. Responsive activity gives way to initiative drives. Failed auctions morph into liquidation breaks. These aren't signals. These are structural evolutions. And when you understand them, you start seeing opportunities where others see noise. For example, a single print at the top of a profile isn't just a shape, it's evidence of a buying tail. That tail is emotional. It represents aggressive buyers who may or may not find follow-through. If value begins to build below that tail, it's a sign of rejection. But if volume starts accepting above it, structure confirms continuation. You're not guessing anymore. You're tracking the market's logic in real time. This is why structure always beats prediction. Prediction locks you into bias. Structure forces you to assess the now, and the market lives in the now. Every moment, it's evolving, auctioning, seeking balance. Your job isn't to anticipate its destination. Your job is to understand its path. Think of a professional poker player. They don't predict the next card. They play the structure of the game, the odds, the behavior of their opponents, the texture of the hand. That's how you must approach trading. Not by betting on an outcome, but by playing the structure. Let's be blunt. Every time you trade without structure, you are lying to yourself. You're pretending the market owes you something. It doesn't. It only offers context, and it's your responsibility to understand that context before you commit your capital. So stop asking, where is price going? Start asking, what is the market trying to do, and is it succeeding? That one shift changes everything. You go from hoping to executing, from reacting to anticipating, from emotional to professional. Structure doesn't guarantee profits, but it does guarantee clarity. And in a world of uncertainty, clarity is your greatest edge. You've been staring at price like it's the answer, like every tick contains some hidden truth. But here's the reality. Price is noise until it interacts with value. You've been watching the market's face, but you've ignored its voice. And the voice of the market? That's value. Not headlines, not candles. Value is the battlefield where real trades are fought and won. Dalton's work drives this point home. Value is where the market agrees. It's the zone where buyers and sellers find equilibrium. Price may probe, spike, retreat, fake out, but value is where business gets done. And if you're not anchoring your decisions to value, you're trading smoke. Think of value as the gravity of the auction. Every day, the market tests high and low. It explores extremes, but eventually it returns to where participants agree. That's the value area. And that area, typically the middle 70% of time spent, becomes your reference point. Not the high of the day, not the latest breakout. Value. You've probably seen it yourself. You buy a breakout only to watch it collapse. You short a breakdown only to see the market retrace and rip higher. Why? Because you were reacting to price. But price without value is just a heartbeat without a body. It spikes. It fades. It means nothing without structure. Dalton teaches that price moves are often emotional. They're driven by short-term traders, news events, stop runs, and algorithms. But value development? That's institutional. That's the slow grind of volume building, of real positions forming. That's where you want to align. Not with the noise, but with the consensus. Let's make this practical. Imagine price breaks above the previous day's high, and you think it's go time. But instead of continuing, it pauses, rotates, and begins forming a new high-volume area just below that breakout. What's happening? Price explored a new area, but value didn't follow. That's not a breakout. It's a failed auction, and it's your cue to fade it, not follow it. Now imagine the opposite. Price breaks out, and then volume begins to pour in. Time is spent above the old value. New highs are accepted. The value area shifts. Now, that's structural acceptance. That's when you look for continuation. Same price, same breakout. Entirely different outcome because of value. This is why understanding value changes your psychology. It gets you out of the chase high, panic low cycle. It teaches you patience. You begin to wait for confirmation. You begin to understand that not all moves matter. Only those backed by value have conviction. Let's talk about the edges of value, the unfair high and the unfair low. These extremes are often where emotional traders enter and where professionals fade. Dalton emphasizes that value doesn't just anchor trades, it defines risk. You can build a plan around value because it's stable, observable, and repeatable. Price alone doesn't give you that. And here's something else most traders miss. Value isn't static, it develops, it migrates. What started as yesterday's value can be tested, accepted, or rejected today. Your job is to track that migration. Is value moving higher, lower, staying the same? That evolution gives you directional context. Suppose you're day trading and the market opens above yesterday's value. You think, great, long bias. But during the session, price drifts back into the prior value and stays there. That's not bullish. That's rejection of the higher prices. Without value acceptance, that open above was just excess, not intent. You'd be right to fade it, not chase it. This is what separates signal chasers from professionals. Professionals ask, where is value? How is it evolving? Am I trading with it or against it? Because trading against value isn't just risky, it's reckless. Let this sink in. Your edge is built around value, not around being early, not around being right, around being aligned with where the market is doing business. That's where liquidity is. That's where size can be absorbed. That's where you stop getting run over by false breakouts and start riding real momentum. So stop treating price like the holy grail. It's just a vehicle. Value is the map. Price will take you anywhere, but only value tells you whether that destination matters. If you want consistency, stop chasing candles. Start building your trades around value. Because where the market agrees, that's where your edge begins. Have you ever bought at the high, only to watch price crash 5 seconds later? Have you shorted into a flush just to see the market violently reverse? Those moments, the ones that leave you staring at your screen, questioning everything, usually happen at the unfair high and unfair low. And if you don't know how to spot them, they'll trap you over and over again. Dalton calls these areas unfair for a reason. They represent prices outside of value that the market tests, but ultimately rejects. They're the fringes of the auction, the emotional edges, where weak-handed traders enter late and smart money takes the other side. These are not the places where business is done. They're where business is tested and often fails. And if you can learn to recognize them, they can become some of the most powerful zones for low-risk, high-reward trades. Let's back up. Every auction revolves around value, where the bulk of trading occurs, where participants agree. But the market doesn't just sit in value. It explores. It pokes outside the value area to test how far it can go before being rejected or accepted. These probes are not mistakes. They're vital to discovering new interest. But here's the catch. Not all exploration leads to continuation. Sometimes the market extends and snaps back violently. That's the unfair high. That's the unfair low. Imagine price pushes above the previous day's range in the opening minutes. Volume is light. Time is sparse. Price forms a thin single print area on the profile. Traders scream breakout, but Dalton would ask, is value following? Is time being spent? Is volume confirming? If not, that move is excess. That's an unfair high. It's emotional, unsustainable, and it's a trap. You've probably felt the sting. You see price breaking out, you jump in, and suddenly collapse. Why? Because the auction tested an area where there were no serious buyers. Only you. And traders like you, reacting emotionally, not thinking structurally. You bought someone else's exit. You were their liquidity. This is the kind of behavior Market Profile helps you anticipate. You stop asking, can I catch the move? And start asking, is this move supported by value? That shift saves you from endless losses. But here's the beauty. Unfair highs and lows can also become your edge. Because they offer asymmetric opportunity. When the market pokes outside of value and quickly rejects, you get a clear signal. Price has gone too far. Traders are trapped. And you have the chance to fade the emotion and align with structure. Take the unfair low. Price sells off aggressively, breaking below value. Everyone's panicking. But then something changes. Price bounces. No follow-through. The next bars reclaim the edge of value. Volume picks up. Now you're not guessing. You're seeing a failed auction in real time. You can go long, not chasing strength, but fading weakness. Risk is minimal, just beyond the low. Reward? A return to the heart of value. This is where consistency is born. Not from predicting where price will go, but from recognizing when it shouldn't be where it is. Dalton emphasizes the difference between excess and acceptance. Excess is rejection. It leaves clues like single prints, tails, or sharp reversals. Acceptance is commitment. It builds value over time. You can't treat both the same. If you try to trade a rejection like a breakout, you're setting yourself up for failure. What's powerful about unfair highs and lows is that they teach you to think in probabilities. No level is magic. But when structure supports your case, when value hasn't followed, when volume is thin, when the market is clearly rejecting those prices, you have an edge. And your job becomes simple. Fade the emotion. Trade the structure. Let's bring this home. Every day, the market gives you tests. It shows you how far it can push before balance pulls it back. Your job isn't to predict those tests. It's to observe them, measure their validity, and act when the signs of rejection are clear. That's what unfair highs and lows are. Signposts of exhaustion. Warnings that say, this isn't real. And once you learn to read them, you stop being the one getting trapped. You start becoming the one laying the trap. That's not just a shift in strategy. It's a shift in identity. From emotional trader to auction participant. From follower to leader. Respect value. Trust structure. And when price strays too far, don't follow. Wait, watch, and then strike. Have you ever wondered why some price levels seem magnetic, where price stalls, bounces, or accelerates without warning? It's not magic. It's volume. Volume is the market's memory. It tells you where business has been done, where participants are committed, and where risk is truly held. And if you learn how to read it, not just by number, but by context, you'll stop trading noise and start trading significance. Dalton teaches that not all prices are created equal. The ones with the most volume, those high volume nodes, are sticky. They're the price levels where buyers and sellers found agreement, where time and volume converged. These are the prices that matter. The rest? Just pathways. Just tests. Just emotional sweeps across the auction. Let's make this concrete. Look at a typical market profile chart. You'll see peaks and valleys, some price levels thick with letters or blocks, others thin and almost empty. Those thick areas, that's where the market spent time and traded volume. High volume nodes. The valleys, that's where price passed through quickly with little participation. Low volume nodes. Both tell you something, but they tell you very different things. High volume nodes are magnets. They represent fair value. The market likes to return to them. It's where traders are comfortable. You'll often see price whip away from a node, only to come right back. That's not a fluke. That's the auction process working. A retest of where the most business was done. Low volume nodes are the opposite. They represent rejection. Price didn't stay there for a reason. No agreement, no interest. These areas are like thin ice. Price may move through them quickly, but it's unlikely to linger. That's why Dalton refers to these zones as no man's land. They're highways, not destinations. If you learn to read the relationship between these nodes, you start unlocking the market's true map. You begin to see which levels are significant, which are vulnerable, and which are likely to hold. You stop trading off feelings and start trading off market memory. Here's where it gets practical. Let's say price is approaching a low volume area. You've been taught to wait for confirmation, but the market profile tells you more. Price is approaching a rejection zone. If it can't fill that low volume area, if it bounces back, you know the market is saying no. That's a fade. But if price slices through with strength, you don't stand in its way. You recognize that the path of least resistance is now open. You follow momentum, not because of hope, but because of structure. Dalton warns that volume isn't just about numbers, it's about interaction. A level that's traded heavy volume during a trend might signal absorption, not support. It could be where sellers are quietly offloading into buyers. Context matters. That's why you must always ask, is volume confirming acceptance or is it signaling exhaustion? Volume gives you clarity when price confuses you. You may see a massive red candle and feel the urge to short. But when you pull up the profile, you notice that the candle stopped dead at a high volume node. That's not breakdown, that's reversion. Without volume context, you might jump in and get slammed. With it, you can stand aside or even fade the move. Volume also gives you targets. When the market breaks out, it often runs to the next high volume node. When it fails, it falls back to the previous node. This is how professional traders structure exits, not based on gut, but based on where the market has a reason to stop. And this is where your psychology transforms. You stop panicking during volatility because you know where the volume is. You stop forcing trades because you can see when there's no interest. Volume is the difference between guessing and knowing, between chaos and control. Dalton's message is simple but powerful. Volume tells the truth. Price may lie. Candles may deceive. Indicators may lag. But volume, especially volume at price, shows you what the market respects. And when you align with those levels, your trades become more confident, more repeatable, and far less emotional. So the next time you feel uncertain, stop staring at the chart. Look at the profile. Where was business done? Where was it ignored? Trade there, exit there, avoid the rest. Volume isn't just data, it's your compass in the fog. You keep telling yourself you need more discipline, that if you could just follow your plan, stick to your stops, avoid revenge trades, you'd finally be consistent. But let me tell you something that might shock you. Discipline isn't your problem. Structure is. You don't need more willpower. You need more process. Dalton makes it clear, discipline is not a personality trait. It's a competency. And it's built, not born. Every time you blame your lack of discipline for a bad trade, you're missing the real issue. You didn't act emotionally because you're weak. You acted emotionally because you had no structure guiding your behavior. You had no clear framework telling you what the market was doing and how you should respond. So you guessed, and then you reacted. That's not a failure of character. That's a failure of preparation. Think of it this way. Imagine walking onto a battlefield with no strategy. The enemy attacks from the side, and you panic. You retreat, then charge, then retreat again, totally disorganized. That's what your trading looks like without structure. It's not discipline that's missing. It's a plan grounded in process. Dalton emphasizes that when you understand the auction, when you know where value is, where excess lies, where volume confirms or rejects, your decisions become clearer. And when your decisions are clear, your actions become consistent. This is the foundation of trading psychology. Not tricks to calm your mind, but tools to create clarity. You don't conquer fear with courage. You conquer it with preparation. Let's say you have a rule to never chase breakouts. But one day, the market starts moving fast, and you feel the FOMO creeping in. You jump in late, and of course, it reverses. You beat yourself up. I broke my rule again. But what was really missing? A structured context. If you'd had the auction framework in place, if you'd seen that the move had no volume, that value hadn't shifted, you wouldn't have even been tempted. The structure would have made the decision for you. That's the power of process. It reduces decision fatigue. It protects you from your own impulses. It narrows the field so you can focus on what matters. And that, in turn, becomes discipline. Dalton repeatedly highlights the importance of writing down your structure. Pre-market, you should have a plan. What's the prior day's value? Where are we opening? Are we in range, out of range, in balance, or breaking structure? You're not forecasting, you're defining context, and that gives your brain something to hold on to when the emotions hit. Because they will hit. You'll feel fear, you'll feel greed. But structure doesn't care about your emotions. Structure is your anchor. And when you start to treat discipline not as a battle, but as a byproduct of structure, you stop fighting yourself. Here's the truth. Emotional trading isn't just a psychological issue. It's a process issue. When you don't know what the market is trying to do, Every tick feels like a threat. But when you're grounded in the auction, every move has meaning. And when things make sense, you stay calm. Clarity kills anxiety. Dalton's framework teaches you how to build that clarity. You begin with the auction phase, balance or imbalance. Then you track value migration, higher, lower, or unchanged. Then you identify excess. Are we rejecting unfair highs or lows? Then you reference volume. Are these moves supported or emotional? Each step narrows your options. Each layer reduces ambiguity. And with less ambiguity, you make better decisions. It's not magic, it's process. And that process creates emotional stability. You're no longer reacting to the market. You're responding within a framework. You're no longer saying, I hope this works. You're saying, this fits my structure. That confidence isn't just mental. It's earned through preparation, through repetition, through clarity. So the next time you feel out of control, don't ask, how do I become more disciplined? Ask, where is my structure breaking down? Because the real work isn't in resisting temptation, it's in removing it. Structure does that. Dalton gave you the blueprint. Now you need to follow it. Define your context, build your framework, execute within it, and watch your so-called discipline issues dissolve. Discipline isn't what you fight for. It's what shows up when structure leads the way. You keep thinking timing is about speed, about being fast, about getting in right at the top of the breakout or the bottom of the pullback. But that's not timing. That's impulse. And it's the fastest way to bleed your account. Dalton shows us that real timing is about alignment. It's about knowing when the market is accepting a move or rejecting it. If you don't understand the difference, you're not early. You're wrong. And if you're late, it's usually because you're emotional. Let's talk about time. Not the clock, but how time is used within the auction. Dalton teaches that time confirms value. The more time price spends at a level, the more likely it's accepted. The less time, the more likely it's being rejected. This is critical because your trade success isn't based on direction, it's based on context. You're not trading a breakout. You're trading whether the market is accepting higher prices or not. Imagine the market opens and immediately pushes above the previous day's high. Everyone gets excited. Twitter lights up. But then something subtle happens. It can't hold. Price rotates back inside yesterday's range. Time isn't being spent above. No volume, no confirmation. That's rejection. And if you understand that, you can fade the breakout while everyone else is chasing it. This is what Dalton calls a failed auction. It's not a failure because price didn't go higher. It's a failure because time didn't confirm the move. And time matters. Time builds value. Without time, a move is just a probe. With time, it becomes structure. You've been conditioned to think that early is better, that the first entry is the best entry. But in the auction, early is dangerous. The best trades come after confirmation. After you've seen the market test a level, reject it and return to value, or break from value and begin building a new one. That's when you have conviction. That's when you're not guessing. Dalton puts it bluntly. Time regulates all opportunities. You must stop trying to be first. You must start asking, is this move being accepted by time and volume? Is it being confirmed by structure? That's how you know when to engage. Not based on emotion, not based on fear of missing out, but based on the market's own behavior. Let's break this down practically. Suppose the market gaps up, opens above prior value, and starts balancing up there. You're tempted to buy immediately, but you wait, you watch. You see time being spent above the prior high. You see new value forming. Now the breakout isn't just a price move, it's structural. You enter with confidence, not because you're chasing, but because time confirmed your thesis. On the other hand, imagine the same gap up, but it immediately fills. Price moves back into yesterday's range. No time spent above. That's not a breakout. That's excess. And if you jumped in early, you'd be underwater within minutes. That's not bad luck. That's bad timing, caused by trading emotion, not process. This is where time becomes your filter. It tells you when a move is real and when it's noise. You stop getting caught in traps. You stop forcing trades. You start waiting for acceptance. And that waiting, that's not hesitation. That's discipline. One of the biggest lies believe is that waiting is weak, that if you're not in, you're missing out. But Dalton flips that. Waiting is strength. Waiting is power. Because waiting allows structure to form, and structure is where your edge lives. When you time trades based on structure, your psychology transforms. You're not anxious, you're not reactive, you're patient, calculated, confident. You're not hoping price will go your way. You're seeing that the market has already accepted your trade location. That shift rewires everything. And this doesn't just apply to entries, it applies to exits. Dalton's framework helps you understand when a move is complete, when the market has finished accepting price, when it's likely to rotate or revert. You stop holding losers. You stop giving back winners. You stop guessing. Here's the bottom line. Timing isn't about being fast. It's about being aligned. And alignment comes from structure, from observing how time is used in the auction. The more time spent, the more valid the move. The less time, the more likely the reversal. If you want to stop getting chewed up, stop trying to outsmart the market. Let time tell you what's real. And when the market shows acceptance, act with full conviction. The clock doesn't control your trade. Structure does. Let it guide you. You keep looking at candlesticks like they're secrets waiting to be cracked. A bullish engulfing bar, a hammer, a doji. You cling to these as if they're going to save you. But let's be brutally honest. If you're trading candles in isolation, you're just reacting. Dalton makes it clear. You must trade the auction, not the candle. Candlesticks are symptoms. The auction is the cause. And if you don't understand the cause, the symptoms will mislead you every time. It's not that candles are useless. They're visual representations of price behavior. But they lack context. A strong green bar in isolation might look bullish, but what if it's forming at an unfair high? What if it's outside value, unsupported by time or volume? That bar isn't strength, it's excess, a trap. And if you're only watching candles, you're walking right into it. Market profile shifts your perspective. You stop thinking in terms of patterns and start thinking in terms of process. You begin to ask, what phase of the auction are we in? Instead of, what does this bar mean? Dalton teaches that candles are footprints, but the profile is the path. One step doesn't tell you where someone is going, but the sequence does. Let's say you see a long red candle slamming into a previous support zone. Most retail traders immediately scream, breakdown. But what if you checked the profile and saw that price had just hit a low volume node? That area has historically been rejected. And now, instead of chasing a short, you recognize the potential for a responsive buy. The candle looked scary, but the auction told a different story. This is how professionals think. They don't trade bars. They trade behavior. They trade context. Every candle is filtered through the lens of the auction. If it aligns with structure, it's valid. If it doesn't, it's noise. Dalton's framework teaches you to read what the market is trying to do. Are we building value? Are we rejecting it? Are we initiating a trend or balancing? These are the questions that matter, and candles can only answer them if they're placed within this framework. Think about it. A bullish engulfing bar at the center of balance is meaningless. It's trapped in chop. But the same bar breaking above a completed balance area, confirmed by volume, followed by time acceptance. That's not just a candle. That's initiative buying. That's structural change. And that's a trade worth considering. This is the mistake most traders make. They treat every pattern as equal. But in Dalton's world, there are no isolated patterns, only evolving auctions. You're not looking for shapes. You're looking for narrative. You're asking, what is the market trying to accomplish? And is it succeeding? Dalton would tell you to study the behavior surrounding the candle, not just the candle itself. What happened before? Was there a test of the unfair low? Was there an excess tail followed by rotation? Is the candle building or breaking value? These layers matter more than any pattern you've memorized. And here's what happens when you internalize this. You stop overtrading. You stop reacting to every move. You wait for structure to support your idea. You fade when the market shows rejection. You press when the market shows acceptance. Your actions aren't driven by shapes. They're driven by logic. Even on the fastest timeframes, this holds true. If you scalp, the principle is the same. Candles tell you what happened in one moment. The profile tells you if that moment matters. And if it doesn't matter structurally, it's not your trade. This is how you go from reactive to proactive, from scattered to focused. Candles show you snapshots. Market profile shows you the movie. And when you start trading the story, not the scenes, your performance transforms. Let me ask you this. The last time you got faked out by a reversal, did you check if the market was at the edge of value? Did you see if volume supported the move? Or did you just act on the candle? Because that's the difference between trading and gambling. Dalton gives you the lens to interpret behavior, not just patterns. And with that lens, you start acting with clarity. No more guessing, no more second guessing, just structured decisions filtered through the logic of the auction. So, trade the auction. Let the profile guide you. Let structure lead, and leave the candles for decoration. You're still trying to control the market. You want certainty. You want to know if this trade will work, if this level will hold, if this signal is real. But that's not how trading works. Dalton delivers a truth that's both sobering and freeing. You don't build consistency by controlling the market. You build it by surrendering to process. The paradox is real. You win by letting go. Think about it. Every time you tighten your grip, try to force a trade, predict a move, demand a certain outcome, you move further away from consistency. That's not edge. That's ego. And ego doesn't survive long in the auction. Dalton teaches that the market is an evolving organism. It doesn't follow your script. It follows the flow of participants, the constant balance between order and excess, between exploration and acceptance. Your job isn't to predict this evolution. It's to read it and respond. This is the core of building a repeatable edge. You don't guess. You don't react. You observe, measure, and act within the structure the market gives you. Not the one you want. Not the one you imagined. The one that's real, unfolding right in front of you. That's why process matters more than instinct. Instinct is volatile. It's shaped by emotions, biases, and your last 5 trades. Process is stable. It's designed to absorb randomness and reduce noise. And the more you lean into process, the more you free yourself from the need to control outcomes. You want an edge? Here it is. Stop trying to be right. Start trying to be consistent. Consistency isn't born from perfection. It's born from clarity, knowing exactly what kind of market you're in, what kind of trade you're taking, and what your job is in that moment. That's how professionals operate. They don't need every trade to work. They need every trade to fit. Fit the structure, fit the context, fit the plan. Dalton emphasizes this over and over. You must define your edge based on behavior, not outcome. You might take a perfect trade that loses. You might pass on a messy trade that wins. That's not failure. That's discipline. That's process. And if you can live with that, you're free. Freedom in trading comes from letting go of control. From trusting that your framework, applied consistently, will put you in a position to win over time. You're not trying to catch every move. You're trying to catch the moves that make sense within your structure. Take the example of a market-breaking balance to the upside. You don't jump in because it's moving. You ask, is value developing higher? Is volume supporting? Are we accepting new prices? If the answers are yes, you trade. If not, you wait. You don't chase. You don't guess. You surrender to what the auction is telling you. This mindset transforms your psychology. You stop needing to control the outcome. You stop needing to be in every trade. You stop needing the market to validate your worth. That's the deeper lesson Dalton offers. Process not only improves your performance, it stabilizes your identity. When you trade from process, losses don't shake you. They're part of the system. Wins don't inflate you. They're expected. You become neutral. And from that neutrality, true confidence emerges. Confidence isn't thinking your next trade will win. It's knowing your process puts you in high-quality positions repeatedly. That's the edge, not the entry, not the setup, the repeatability. So here's your challenge. Build a process you trust, one rooted in the structure of the market, not the emotions of the moment, one that guides you in volatility, protects you in chop, and gives you clarity in chaos. Stop looking for control. Start building competence. Let go of the fantasy of knowing and embrace the power of responding. Dalton gave you the map. The auction is your terrain. Walk it with awareness. Trade it with discipline. Build your edge, not by force, but by flow. You're not here to conquer the market. You're here to master yourself. You came here looking for consistency. What you found is something deeper, a way to see the market through structure, not emotion. From understanding context to interpreting value, recognizing unfair highs and lows, trusting volume, mastering time, and abandoning the illusion of prediction, you've now seen what separates random trades from repeatable edges. James Dalton's work isn't about secrets. It's about seeing. Market profile isn't a tool, it's a lens. And when you use that lens consistently, your psychology shifts. You stop reacting. You start responding. You let go of control and anchor yourself to process. So what should you do now? Start by observing. One auction at a time. Read Mind Over Markets. Focus on the first chapters about value development. Revisit your last 5 trades. Ask yourself, was I trading the auction or the candle? This series isn't entertainment. It's a call to action. If you want clarity, stop hoping for better trades. Build better structure. Align with value. Respect time. Let go of control. And if this brought you insight, like, comment, and subscribe. Let's raise the standard of how traders think, one profile at a time. Your journey from emotion to edge starts now.